access,
So
EPF,
first click
PPF,
on
NPS, your
okay.
insurance premiums.
So welcome in here. So first you need to click on the pin post. So I do like the way I do airdrop every day. Okay, I'm just showing you in the live section. I cannot talk so much because of video would be nearly 1 hour plus. Okay, so therefore just watch the video and I'm playing the audio. Just listen money talk. Okay.
All fall under ATC deductions up to 1.5 lakh per year. Make these investments. Next, open a demat account to start investing. In equity. Demat account works like an electronic bank for your investments. Stocks, mutual funds, bonds, ETFs. Example, if you buy company shares, it's entered in electronic form in your demat account. It's mandatory to have a demat account for equity investing. Choose from platforms such as Zerodha, Grow, 5paisa, Upstocks, etc. to open your demat account. Plenty of options to choose from. You'll need a PAN card and an Aadhaar card to get started, along with a few other documents that serve as your ID proof and address proof, and carry your bank details. Next, SIPs. Invest regularly to smooth out market volatility. Systematic investment plans or SIPs are not schemes or investment products in themselves. Think of them as EMIs, just that instead of paying a bank, you're paying yourself. Sweet. An SIP is a financial ritual. Every month on a set date, money automatically transfers from your account to a chosen mutual fund, making savings feel less heavy on the wallet. SIPs are also great to manage market mood swings. With SIPs, you buy at regular, set intervals at different market prices. You get more units when prices dip and less when they peak. This averages out your investment cost. It's your shield against market mood swings. SIPs also harness the power of compounding. With SIPs, you stay consistent. It's not just that your main account grows, the returns on that amount grow too. Over time, this multiplies your money. You should pick direct over regular SIP plans. Direct plans generally have a lower expense ratio. This translates to higher returns in the long run. If you're already in a regular plan, though, and direct, check for potential exit loads and capital gain tax implications. Pick the right platform for your SIP. There are numerous platforms that exist: Coin, Grow, ICICI Securities, Angel Broking, Upstocks. Each come with unique features and offerings. Research and pick a platform that aligns with your investment goals and comfort. And don't stop mutual fund SIPs. Market is low, returns are not good, no excuses. Don't stop. And finally, start. Personal finance is personal for a reason. Your approach is yours. Own it. Never let anyone push you to invest in something that makes you uncomfortable. Never invest in anything with the belief that you can't lose. Sometimes you will be luckier than others, other times you won't. Sometimes you will outsmart others, other times you won't. Your only persistent edge in investing is starting earlier than others, being consistent, and being more patient than others. As Warren Buffett beautifully and famously said, the problem is that no one wants to get rich slowly. As we end this really long but important chapter, I want you to think about this. Start investing as early as you can. even if it's a small amount. Compound interest multiplies your money at an accelerated rate.
Yeah.
You earn interest on your interest. The longer your money stays invested, the better for you. Your risk tolerance determines how you invest. Assets with low risk typically give you lower returns. Asset with higher risk could give you higher returns but also higher losses. The wise ones balance risk. How do you balance risk? Asset allocation. You invest across different assets with different risks. What's a good rule to manage risk? The 100x rule. If X is your age, then invest X percent in fixed income, which is lower risk, and 100 minus X percent in equities, which is higher risk. Use the rule of 72 to understand how long it will take to double your investment. The rule states 72 divided by the rate of return of your investment is approximately the number of years taken to double your money. And remember, you playing for the long term. Before we go to the next chapter, I want you to do this. Open a demat account to start investing in equity. Pick a reliable brokerage or bank to open a demat account and dive into equity investments. You can do this online through platforms such as Zerodha, Grow, 5paisa, or Upstocks. You decide your asset allocation strategy. Decide how much you will invest in equity. The 100x rule is a good start. Within equity, decide how much risk you're willing to take. How much in large cap mutual funds? How much in mid cap mutual funds? How much in small cap mutual funds? Within fixed income or safer assets, decide how will you split it among different assets. Example, EPF, NPS, gold, bonds, etc. Automate your investments. Create a separate account to park your savings to invest. Set up auto transfers from your salary account to your investment accounts. Finally, start systematic investment plans or SIPs. They're great to balance out market volatility. Chapter 7, and manage my money well. Most people overestimate what they can do in a year and they massively underestimate what they can accomplish in a decade or two. The fact is, you are not a manager of circumstance. You are the architect of your life's experience. A quote by Tony Robbins. The job I got after graduating post my MBA from the Indian School of Business paid me a lot of money. So I spent it to show that I had a lot of money. Bought a car, upgraded the house, bought appliances, got a credit card. In my 20s, I had a rich mindset, all about spending, all about flexing, living for the present. Now at 40, I wish I had the wealthy mindset, planned for the future while still living life, built and grown wealth consistently for financial security, for financial independence. Our money decisions today determine the quality of our lives tomorrow. Money provides us with opportunities. It drives our ambitions. It fuels our dreams. It gives us freedom. It gives us comfort. Money isn't just currency, it's a lifeline. But here's what's strange. For something so crucial, we don't have a game plan. Most of us are just going with the flow, winging it as we go along. In our 20s, we're all about the carefree life, my rules, and all of that. Then the 30s come around. Adulting crashes the party with bills and grown up stuff. We hit the 40s, 50s. Retirement isn't too far off. Kids start talking about college fees. You need a new laptop? The kids want one too. We don't feel as healthy as we used to, but we are making those ends meet, hanging in there. Still, there's a nagging feeling. We wish we'd planned better. The older we get, the more money matters. But in our 20s, we don't see that. We miss out on the game changing potential of investing. We miss out on the magic of compounding. We miss out on giving our money enough time to grow. Starting early is the way to go, but it's never too late to start. Get intentional about your money. It's your money story. You write it. Your financial plan must evolve with each life stage. Picture this: you're in your 20s earning 5 lakh rupees annually. You're living with your parents, few bills, no dependents. Life's great. Jump to your 30s, that same 5 lakh feels tighter. Family responsibilities grow, health concerns arise, your parents are also getting old. Now in your 40s, that same 5 lakh could spell disaster. Retirement is getting closer. What's the plan, bro? This situation may be unlikely, but the point of this example is still valid. Your money game has to level up with increasing age and income. So let's visualize your life across 3 decades: 20s, 30s, and 40s, and across 3 income bands: annual salary of less than 3 lakhs, 3 to 9 lakhs, and above 9 lakh rupees. There you have it, a 3 by 3 grid, 9 different combos, 9 game plans. Find your place in the grid. Think of this as the only 3 by 3 cheat sheet you need for the game of life. Financial planning by age and salary. If your age is in your 20s and income is less than 3 lakhs per annum, the headline: you have time. Take risks, find ways to boost your income. First, financial protection. Emergency fund build for 3 months. Health insurance for your parents, they need it. You can be without one right now. Life insurance can wait till your 30s or till your income exceeds 9 lakhs annually. Don't spend more than 20% on your desires. At this income, you can't afford to spend more than 20% of your monthly salary after tax, my friend, on things you desire. Find ways to increase your income. Upskilling is a great way to do this. Study further, start and complete online courses, take up odd jobs, earn more money, look for other active or passive income opportunities. Share about this in detail in the chapter titled Now I Really Want to Earn Some Money. Invest at least 30% of your income. Time is your biggest asset. That's what you're going to leverage. Most of your portfolio should go into the stock market to maximize the power of compounding and get yourself higher returns. A small portion will go towards fixed return assets for safety. It will provide you with a steady interest. Skip assets like gold, real estate, and crypto till you increase your income. Here's a potential investment plan for the amount you invest: 25% to fixed return assets, which are FDs, EPF, PPF, debt mutual funds, 75% to mutual funds. Within that, 40% in the Nifty 50 mutual funds SIP, 30% in mid cap mutual funds SIP, and 30% in small cap mutual funds SIP. Avoid all credit cards and loans. They just invite overspending, which you can't handle at this income level. Next, if you are in your 20s and your income is between 3 to 9 lakh rupees per annum, the headline: you have time. Take risks, live large, but keep that spending in check. First, financial protection. Emergency fund built for 6 months. Health insurance for yourself and your parents. It can be combined if you're single. Life insurance: get life insurance coverage at 20 times your salary with the ability to increase it later. Don't spend more than 25% on your desires. You're young, a steady income is rolling in. It's easy to get carried away. Don't be. Stay within 25% of your monthly after tax earnings. Before you spend, ask yourself, do I really want it? You have time. Use it to grow your investments. The stock market will be your best friend to maximize the power of compounding and get yourself higher returns. Go big on small cap and mid cap mutual funds. Risky? Sure, but you can afford the risk. Time is your cushion. Think of them as calculated risks. Balance it out with stable fixed return investments. With a fixed interest, they provide a safety net. Diversify. Try gold, real estate, REITs, perhaps even crypto. Real estate needs a hefty upfront sum. REITs, just 500 and you're in. Crypto's volatile. Pick it up only if you understand it and if you believe in its long term potential, not because others are doing it. Here's a potential investment plan for the amount you invest: 20% in fixed return assets, FD, EPF, PPF, debt mutual funds, 75% in mutual funds. Within that, 30% in the Nifty 50 mutual funds, SIP, 40% in mid cap mutual funds SIP, 30% in small cap mutual funds SIP. 5% could be to gold or real estate or to crypto. A credit card is okay. Do not get one with an annual fee. If you want to get, consider a FD backed one. It uses the money in your FD to give you a credit limit. A credit helps build a good credit score. Don't forget to pay your bills in full and on time though. Taking a loan is okay, but only for education or a car. Education can be an investment in your future, hopefully leading to better jobs and income.
আছে
A car can save on commute. Take on what you can pay back easily. Definitely no personal loans. Now let's look at 20s and your income being above 9 lakhs per annum. Headline: you have time and money. Live your best life and keep investing smartly. First, financial protection. Emergency fund build for 12 months in your case. Health insurance for yourself and your parents combined with top up. Life insurance, get life insurance coverage at 25 times your salary with the ability to increase it later. Don't spend more than 30% on your desires. You're young and restless, income's looking good too. You deserve your own fun fund. Keep a generous 30% to splurge, you've earned it. But remember, it's easy to overspend when things are good. Invest consistently, leverage time, focus more on the stock market for growth. Go big on small cap and mid cap mutual funds for risky but big gains over the long term. Balance the risk with steady return from fixed investments. Keep only a small chunk here though. Fixed returns barely keep up with the inflation. Diversify those investments. Try gold, real estate, REITs, crypto. Real estate needs more upfront money, and REITs, you can start small with 500 rupees. Crypto is volatile and complex, so invest only if you understand it. This mix aims for higher returns while keeping things in check. Here's a potential investment plan for the amount you invest. 15% in fixed return assets, so FD, EPF, PPF, debt mutual funds. 80% in mutual funds. Within that, 25% in Nifty 50 mutual funds SIP, 40% in mid cap mutual funds SIP, and 35% in small cap mutual funds SIP. 5% to either gold or real estate or REITs or crypto. Get a credit card. Make it work for you. It's great for building a good credit score. Plus, reward points and freebies. Why say no at this income? Don't forget to pay your full bill every month. Hear about this in detail in the chapter titled So That I Can Spend It Wisely. A loan is also fine, but only for education or a car. No home loan as yet, even though you can afford it, because you're way too young to commit. Now let's move to your 30s and pick up your income if it's less than 3 lakhs per annum. Headline: protect your savings. Focus on income growth. First, financial protection. Your emergency fund should be built for 6 months. At this age, you need protection. Health insurance for your parents. At this age, they need it more than you do. Life insurance, get coverage at 15 times your salary. Don't spend more than 15% on your desires. You have no choice, my friend. Your income is limited. So your desires need to reduce too. Find ways to increase your income. Don't just stick to your day job for income. Think beyond. There's a bunch of ways to earn actively or passively. Take your skills and talent to the next level by freelancing or consulting. Beef up your skills with online courses. Hear about this in detail in the chapter titled Now I Really Want to Earn Some Money. Invest while playing safe. In your 30s, time is still on your side, but it's more precious than before. Let's use it strategically. Focus the core of your investing on the stock market. Let compounding work its magic. Keep a large share in fixed assets. They offer stability and lower portfolio risk. Give assets like gold, real estate, and crypto a miss. We don't have the income for that right now. Here's a potential investment plan for the amount you invest. 30% goes in fixed return assets, FD, EPF, PPF, debt mutual funds. 70% goes in mutual funds. Within that, 70% in Nifty 50 mutual funds SIP, 25% in mid-cap mutual funds SIP, and 5% in the small cap mutual funds SIP. Avoid credit cards and loans. They invite overspending. Juggling debt on a tight income can be tough. Now let's look at your age in your 30s and your income between 3 to 9 lakh rupees per annum. The headline: decent place to be. Time is still your best asset. Don't be greedy. Don't be scared. Stick to the plan. First, financial protection. Emergency fund built for 9 months since you can afford to. Health insurance for yourself plus spouse plus kids and for your parents with top up. Life insurance, get coverage at 20 times your salary with the ability to increase it later. Don't spend more than 20% on your desires. Think of it as your personal indulgence budget on an after-tax income basis. But don't cross that line. This range lets you treat yourself and invest smartly. It's a happy middle ground. Don't make hasty investment decisions. Don't let shortcuts and quick gains tempt you. They can cloud your financial judgment, push you to take bigger risks than necessary. Say no to spur of the moment choices driven by emotions. Stick to your investment plan even during market volatility. Find ways to increase your income instead. Choose side gigs that align with your passions and skills. Think freelancing, consulting, and more. Hear about this in detail in the chapter titled Now I Really Want to Earn Some Money. Make your money work for you. In your 30s, seeking stability makes sense. But remember, time is your ally. Use it to leverage compounding. dedicate a smaller portion to fixed return assets. They keep things steady and dial down overall risk. But their returns might not outpace inflation by much. The core of your portfolio should focus on the stock market for growth and higher returns. Nifty 50 takes the lead with consistent earnings. A little less goes into the riskier mid cap and small cap options. Avoid assets like gold, real estate, and crypto. Consider them once your income rises. Here's a potential investment plan for the amount you invest. 25% goes in fixed return assets, FD, EPF, PPF, debt, mutual funds. 75% goes in mutual funds. Within that, 60% in Nifty 50 mutual funds SIP, 30% in mid cap mutual funds SIP, and 10% in small cap mutual funds SIP. A credit card is okay at this stage. Pay the bill in full always. This allows you to build a credit score without taking a loan. Please avoid loans. Let your income grow before considering loans. No home, not yet. A car only if you really need it. Now let's look at your 30s and your income above 9 lakhs per annum. Headline, it's a good place to be. Be consistent and smart with your investments. First, financial protection. Emergency fund build for 12 months. Health insurance for yourself and your spouse and your kids and your parents separately with top up. Life insurance, get coverage at 25 times your salary. Don't spend more than 30% on your desires. Your solid income sets a strong foundation, so you get to spend 30% after tax income on your desires. Yay! Focus on passive income sources. Your talents and skills can fetch you passive income. Think freelancing, consulting, and more. Anything you wanted to pursue but didn't have the financial means to. With your stable income, this could be a good way to explore your passion. Hear about this in detail in the chapter titled, Now I Really Want to Earn Some Money. Invest consistently. Investing regularly gives you a competitive advantage of time and money. Let compounding work its magic over the years. It's not about timing the market, it's about giving your investments time to grow. Here's a potential investment plan for the amount you invest. 20% goes in fixed return assets, FD, EPF, PPF, debt mutual funds. 75% goes in mutual funds. Within that, 50% in the Nifty 50 mutual fund SIP, 35% in the mid cap mutual funds SIP, and 15% in small cap mutual funds SIP. 5% goes to gold or real estate or REITs. Get a credit card. At this income, benefit from the 30 to 45 day interest free loan, the chance to build your credit score and enjoy freebies. You've earned it. Hear about this in detail in the chapter titled So That I Can Spend It Wisely. Taking a loan is okay as long as it's for a home or a car. Think of them as good ways to enjoy your money, but always be in a hurry to pay off the loan. Remember, one extra EMI per year plus 10% higher EMI every year reduces a 25-year loan to just 10 years. Hear about this in detail in the chapter titled So That I Can Spend It Wisely. Now let's move on to your 40s and the income band of less than 3 lakhs per annum. Headline, a dangerous place to be. Protect. Focus on growing income. First, financial protection. Emergency fund build for 9 months. Do not think of anything else before this. Health insurance for yourself, plus spouse, plus kids, and for your parents. Critical. Life insurance, get coverage at 10 times your salary. Critical at this stage. Can't spend more than 10% on your desires. You have wants, so does your family, but remember your income has its limits. So adjust your desires accordingly. The key is to live within your means. Don't fall for get rich quick schemes. When money is tight, get rich quick schemes can be tempting. Sure, they dangle the idea of quick cash, but they come with
করেন না
sneaky risks. strip any gains. In your 40s, wiping out your savings isn't the route to take. Find ways to increase your income. Put your skills to work. Find odd jobs to supplement your income. Hunt for higher paying roles. Hear about this in detail in the chapter titled Now I Really Want to Earn Some Money. Play it safe. Invest regularly, but very cautiously. Let's steer clear of any crazy risks. The smart investment play is balance. Split it 50-50. Half for steady fixed returns and half for the stock market. In the stock market, 80% hangs with the reliable Nifty 50. 20% in mid cap mutual funds for more growth. Small cap mutual funds? Not at this time. They are too risky for your age. Gold, real estate, and crypto? Nope, not enough income to digest these yet. Here's a potential investment plan for the amount you invest. 50% goes in fixed return assets, FD, EPF, PPF, debt, mutual funds. 50% goes in mutual funds. Within that, 80% in Nifty 50 mutual funds SIP, 20% in mid cap mutual funds SIP, and zero in small cap mutual funds SIP. Absolutely no credit cards and loans. With lower earnings, repayment be a hassle. Now let's look at your 40s and your income between 3 to 9 lakh rupees per annum. Headline: a tricky place to be. Focus on side income, choose renting over buying. First, financial protection. Emergency fund build for 9 months. Health insurance for yourself, spouse, kids, and No more than 15% on your desires. At this stage, you've got big responsibilities. Maybe a home loan already, kids' education, retirement planning. Prioritize these. By keeping wants to 15%, you keep a good chunk for needs and leave some for investments. This keeps debt in the chapter titled So That I Can Spend It Wisely. Find ways to increase your income. Put your expertise to work. Try consulting, freelancing, or side gigs. Focus on upskilling to get higher paying roles. Reach out to your connections for job referrals, new opportunities. Hear about this in detail in the chapter titled Now I Really Want to Earn Some Money. Continue investing. Yes, even at this age. In your 40s, your responsibilities take center stage. Avoid the extremes. No ultra safe or super risky moves. With a steady income, try a 40-60 split. 40% in steady fixed returns, the rest in the stock market. Fixed returns suit your age and income, the stable anchor in your portfolio. In the variable realm, it's 75% in the Nifty 50 for dependability and add 25% in mid-cap mutual funds for extra gains. Small cap mutual funds, real estate, and crypto, I'd suggest you skip them, too risky. Here's a potential investment plan for the amount you invest. 40% goes in fixed return assets, FD, EPF, PPF, debt mutual funds. 60% goes in mutual funds. Within that, 75% in Nifty 50 mutual funds SIP, 25% in mid-cap mutual funds SIP, and 0 in small-cap mutual funds SIP. Avoid credit cards and loans. They can lead to unnecessary debt and financial stress, neither of which you need right now. And finally, let's look at your age in your 40s and your income above 9 lakhs per annum. Headline, a safe place to be. Protect yourself, invest consistently. First, financial protection. Emergency fund, build for 12 months. Health insurance for yourself, plus your spouse, plus kids, and for your parents with top up. Life insurance, get coverage at 20 to 25 times your salary. Don't spend more than 25 to 30% on your desires. When you're in a good financial space, splurging can be tempting. But don't forget the golden 25% rule. Buy only stuff you really want. Otherwise, you'll end up with the things you will regret having bought and with less money. Keep the focus on needs, protection, and future goals. Focus on consistent investing. You are not late. Start investing if you haven't already. You still have time. You certainly have money. Make that money work for you. Your investment strategy? Let's take some calculated risks with your strong income. Around 30% in fixed returns, the rest in the stock market. Fixed returns maintain stability. Among the variables, 70% goes to the more stable Nifty 50. Allocate 30% to mid-cap mutual funds for that growth push. But for now, small cap mutual funds take a backseat, a tad too risky. No real estate and crypto either. Here's a potential investment plan for the amount you invest. 30% goes in fixed return assets, which is FD, EPF, PPF, debt mutual funds. 70% goes in mutual funds. Within that, 70% in Nifty 50 mutual funds SIP, 30% in mid-cap mutual funds SIP, 0 in small-cap mutual funds SIP. Get a credit card. Use it wisely within your limits. Pay the bill in full and on time. Enjoy the freebies. Build that credit score. Hear about this in detail in the chapter titled So That I Can Spend It Wisely. A home loan at this stage is okay. It's a chance to invest in a valuable asset, your own home, and get tax benefits. As retirement nears, it also offers stability. With a solid income, managing repayments is also easier. In the end, your financial path is shaped by your age and your income, along with what you want in life and your responsibilities. You have the cheat sheet, but you're holding the cards. Only you decide how to play them. As Ram Das beautifully says, you can do it like it's a great weight on you, or you can do it like it's a part of the dance. As we come to the end of this chapter, I want you to do this. Find out where you are on this 3x3 grid. Make adjustments to your financial plan accordingly. Emergency fund, health insurance, life insurance. What's the max amount for bonds? How much to invest in fixed return assets? How much to invest in mutual funds? Large cap, mid cap, small cap. How much to invest in gold, real estate, other assets? Whether you can take credit cards or loans. And figure out where you will be on this grid 5 years from now and how you will have to adjust your financial plan accordingly. In the supplemental PDF, we have provided a very clear summary for each of the decades and each of the income streams. So for your 20s, salary below 3 lakhs, 3 to 9 lakhs, above 9 lakhs. For your 30s and your 40s, the same income band. These tables can be referred to in the supplemental PDF. Chapter 8. I know I'll make mistakes. Nothing in life is to be feared. It's only to be understood. Marie Curie. When I first spoke in public, I was clueless. I froze. No words came out. When I made my first investment, I was clueless. Crossed my fingers, hoping for the best. When I made my first Instagram post, I was clueless. Got 3 likes, not a single comment. Everyone starts at 0. You will make mistakes. In fact, the system circumvent the system by learning from your own mistakes. Beat the system by learning from the mistakes of others. Mistake number 1, believing the zero risk lie. Everything in life carries a risk. Dating, work, career, and yes, money. Some risks are obvious, right in front of us. Gambling, investing in crypto or NFTs. Confessing that you like pineapple on pizza. Telling your mom the actual price of the gift you got her. But just because something is risky doesn't mean it should not or cannot be done. Risk cannot be eliminated. It can only be understood and managed. When you're young, your ability to take risks is higher, not because you've got it all figured out, because you have time. Time to recover from any damage that may be caused by the risk. Two independent truths exist when it comes to risk and money. Number one, low risk will almost always mean low returns, or else everyone would be doing it. So the takeaway is your money will not grow in low risk assets. Number two, high risk need not always mean high returns, or it wouldn't be called high risk after all. So takeaway there is you won't get rich overnight just because you took a massive risk. This is what I would do. I'd play the long-term game to manage, not eliminate higher risk. Here's an example. If you were to invest in the Nifty 50 for 1 year, the worst possible return is minus 20%. The average return is 13%. And the probability of negative returns is 25%, and the probability of above 8% is 50%. However, if you were to now invest for 3 years in the Nifty 50, the worst returns now only become minus 2%. The average returns are still about 13%. The probability of negative returns drops to only 15%. And the probability of getting a return above 8% is now 75%. If you were to now invest for 5 years in the Nifty 50, your worst returns are now 5%. Your average returns are 12%. The probability of negative returns is 0. And the probability of getting an above 8% return is 90%. And if you were to invest in the Nifty 50 for 10 years, the worst return possible is 6%. The average returns is 12%. The probability of negative returns is 0%. And the probability of having above 8% is nearly 100%. All of this, of course, is historic data. And we've given a table summarizing this in the supplemental PDF that you should go and check out. But let me summarize the key takeaway. If you invest in Nifty 50 for a year, there's a 25% chance that you will lose money. Only a 50% chance that you will beat inflation, which is 8% returns pre-tax. If you invested in the same index for 5 years, there is 0 chance based on past data that you will lose money, and a 90% chance that you will earn above 8%. And if you invest for 10 years, the chance of earning above 8% goes to nearly 100%. Did you eliminate the risk? Nope. You managed it through time. Smart. Mistake number 2, short-term thinking. YOLO is a drug. It intoxicates us. It makes us believe that all money earned should be spent. Live for today. You only live once. No, you don't live only once. You live every day. And you're going to live for a really long time. During this long time, there will come a phase where your income will stop. You will want to make a big purchase, or 10, for which you will need a lot of money. You will have an emergency situation, or 5, where you will need a lot of money. The need for instant gratification, it's costlier than you think. Live well today. Also, live responsibly. Budget. Max 30% of your income for your desires. Minimum 20% for your future. Keep that YOLO meter on, monitor it, do it for yourself and for those who will walk beside you. Mistake number 3, ignoring inflation. Inflation isn't some abstract concept you read in books. It's real. Picture this. You've saved 1 lakh. Awesome. You keep it snug under your mattress. A year goes by. You still have 1 lakh under that trusty mattress. Yay! That's awesome, no? No. It can't buy the same amount of stuff as it could last year, though. That phone or that vacation, they've become pricier. Blame it on inflation, the silent money eater. It erodes your money's purchasing power bit by bit. Think 5% inflation yearly. Your 1 lakh is just 95,000 after 1 year in terms of buying power. After 2 years, closer to 91,000, like a slow leak. 10 years go by, without smart investing, your money feels more like 50,000. Ouch! When weighing your investment returns, don't just look at the absolute number, factor in inflation. If your investment earns 5% and inflation is 5%, your real return is zero. Inflation is real and it's relentless. Then there's that thing about reported inflation and your personal inflation, aka lifestyle inflation. The 5% that the government announces, it's quite possible that your expenses are growing faster than that every year. That's because you're not the average spender. You spend on things not everyone spends on. Your unique spending patterns, like frequent dining out, latest fashion buys, entertainment, and travels, are different from others. For many, the real inflation rate may hover closer to 8 to 9%, which means if you want your money to grow, you have to earn at least 8% post tax every year. Did I mention inflation is real and it's relentless? Mistake number 4, ignoring taxes. Everyone thinks that taxes are a bummer, something we want to avoid, painful. Ah, flip the script. They are badges of adulting success, a statement of your financial well being. You're making money, so you're paying taxes. It's proof of your work. In the supplemental PDF, we've attached 2 QR codes that you can scan to get a complete guide to tax planning. One of the QR codes takes you to the complete guide to tax planning for salaried peeps, and the second QR code takes you to an Excel sheet for tax tips for freelancers. Let's talk about capital gains tax. Capital gain is the profit you make when you sell an equity asset, stocks, mutual funds, ETFs, for higher than its purchased price. Capital gains tax kick in only when you sell. For example, you bought stock for 500, its value is now 600. On paper, your profit is 100. You don't pay tax on this. It's an unrealized gain. Only when you sell this stock, you make a profit of 100. That's realized gain. You pay tax on only realized gain. Types of taxes on realized capital gains. Number 1, short-term capital gain or STCG tax. The duration, if the asset is bought and sold within 1 year. The tax, 15% on the profit. The second type of tax is the long-term capital gain or the LTCG tax. The duration, if the asset is sold after a year of buying it. The tax on this is 10% if your profit is greater than 1 lakh. If your profit is less than 1 lakh, no tax. Finally, taxes are a real thing. Research, save when you can. File your returns every year or get an accountant to do it for you. Mistake number 5, living beyond your means. Swipe, click, buy, repeat. New gadgets? Got it. Super cool shoes? Sneakers? Bought. Ordering in every night? Why not? Eating out every weekend? Absolutely. Thanks to credit cards and easy to get EMIs, we think we have more money than we actually have. We earn 1 rupee but spend 2. Then we want to earn back the money we have lost. So we make more mistakes. Fall for get rich quick schemes. Gamble. Do not spend money that you do not have. Mistake number 6, ego. Ego is like your social media filter, the Insta you versus the raw, unfiltered you. We spend our lives trying to keep our ego happy. What will they think of me? How can I shine brighter? What can I buy that others will want? Take a moment. Track your expenses for a week. Just 1 week? How much of it truly sparks joy? And how much is for others? If it's for the world, it's your ego. Leave it at the door. The ego is difficult to tame, but it's exhausting. It's financially draining, and you end up playing someone else's game. Acknowledge the ego, face it, then rise above it. Stay true to yourself, stay authentic every single time. Mistake number 7, not understanding the dark side of compounding. Compound interest is a double edged sword. It can be your best friend or your worst enemy. Just depends on which side you're playing on. Compounding is great for investments, a nightmare for debt. For those with high interest debt, compounding turns into the evil villain, paying interest on interest. The reason it feels like the outstanding amount on a credit card just never seems to go down. Taking a loan can be a good thing to help build assets like your education, to help you save money, to help refinance high interest loans. Taking loans at high interest rates can be a terrible thing. When you buy things to flash the I've made it sign, when you use it to make investments that don't outpace the interest you pay, when you don't have the means to pay it off. Financially smart people take loans, even if they can afford it, to save money. Financially weak people take loans knowing that they can't afford them to spend money. Mistake number 8, not understanding that most purchases have a hidden cost. I took a loan to invest in real estate, assuming that the price appreciation would take care of the interest rate I paid. I forgot the hidden fees: registration, the brokerage, the capital gains tax on selling, taxes and inflation. Yep, missed those too.
প্যাকেট হবে হলে 100 ফ্রেশের বুঝছো বন্ধ বাবা 2 নম্বরে চালে ফ্রেশ তো না তেল তুই দুই তেল আলাদা হ্যাঁ আর তো চেনই মেঘনা গ্রুপ বাংলাদেশের মধ্যে সবচেয়ে বেশি বিক্রিত জিনিসটার চাইলে এটা খায়া মজা পাবে একবারে সর্বোচ্চ গন্ধ বাবা 150 টাকা 170 টাকা দাম 150 টাকা নেই 120 টাকা না বলে আড়া চাইলে আছে 800 টাকা কেজি না সেটা খাবো না কিমান করে কাটালি ভোগ না 800 টাকা কেজি আমার এটা কাস্টমার আছে কম আছে নি না এটা কম হবে না ফ্রেশ কম না এটা 2 নম্বর হবে যেটা ওই খোলা উঠে প্যাকেট করে না ভালো হবে এটা 100 কিলো বন্ধ পাবো নিয়ে গেছিল তো ওই যে খোলা উঠে বান্ধে পাবাই তো
all of which reduce the actual return I made. This isn't just about property. Most things come with hidden costs: flight tickets, gadgets, cars, investments, sneaky processing fees, charges if you change your mind, subscriptions that auto renew when you least expect, the so called convenience fees. Yeah, pretty inconvenient actually. Some fees are negligible, others are not. Before you buy, do your research. Read the fine print. You can't avoid every hidden cost, but at least you know what you're signing up for. Mistake number 9, relying on one job to build your wealth. One income stream, one salary, all eggs in one basket. We know how that story ends. Job requirements evolve, industries shift. Your employer determines your value and your salary. One shakeup and you're off track. In a world where change is the only constant, broaden your horizon. Keep your day job, but build income streams beyond it. Invest, start a business or a side gig, create intellectual property, consult or coach, teach, freelance, build a personal brand. Your salary is not enough. Diversify your income, just like your investments. As Robert Kiyosaki in Rich Dad Poor Dad wonderfully said, my poor dad said, I can't afford it. My rich dad asked, how Can I afford it? The first one lets you off the hook. The second one forces you to think. Mistake number 10, not creating a margin of safety. Hope is great. Blind optimism is not. The most important thing is to plan for this one question. What if things don't work out as you think they will? Always have a buffer. Build that emergency fund. Get health insurance. Get life insurance, especially if your family leans on you
उस्ताद
financially.
खाया मलाई बाबा मान्छे
Hope for the
सवाद दिँदै
best.
बगाउने
Prepare for the unexpected. Can get wealthy only by taking from someone else. Growing up, I hated money. We didn't have it, so I thought it was the cause of all our problems. I hated rich people as well. Because why do things in half measures? Hate everything and everyone. I thought they were shrewd and corrupt. I believed that someone got rich only by driving someone else to poverty. Wealth was a zero sum game to me. Today, I realize that my ignorance about wealth drove my emotions. Everybody can create value, everybody can build wealth. It doesn't have to come at anybody's expense. There can be multiple winners in the game of money, in the game of life. Mistake number 12, believing that investing is a quick race to riches. Investing is not speculation. Investing is not making money to impress someone. If done right, investing your money can be one of the most fulfilling things you do. If done right, investing is a long-term game to build wealth. The fastest way to become wealthy is to go slow. The earlier you start, the better. The longer your money is invested, the better. Growing up, I saw queues for everything, from milk to phone connections. We had no choice but to be patient. And so we learned patience. You might not know that word, but teach yourself patience, because life's best rewards take time. Mistake number 13, not realizing that the system is designed to keep you poor. We've been trying to play the system our whole lives. In reality, the system has been playing us. The system wants you to take loans at high interest rates. It wants you to keep spending on credit cards. It wants you to desire things and buy them on EMIs. It sells desires. It sells aspirations, even if you don't have the capacity to afford them. It sells ideas of success, even if those ideas are not your own. Pay later. Pay the bare minimum. How it earns. The system wants you to burn your money in an FD. It offers you interest rate equal to or lower than inflation under the garb of safety. Money that they can then loan you back at higher interest. The system encourages you to have one job, to be dependent on that one income stream so that you can take loans, so that you never leave your job. The system endorses the consumerist society. Flaunt, repeat. This is trending, implying, shouldn't you get one too? 844 people bought this, it tells you, implying, can't you afford one too? The system wants you to make impulse buys. The 15% discount will end in 3.22 minutes. It tells you it's super convenient. One click buy and you're done. The system draws battle lines between you and your friends, you and your peers, you and the world. The system makes us want what the other has. As Montesquieu wonderfully said, if you only wish to be happy, this could be easily accomplished. But we wish to be happier than other people. And this is always difficult, for we believe others to be happier than they are. As we end this chapter, I want you to think about this. Perfection isn't the starting line, action is. You don't need to have perfect knowledge, perfect data, or the perfect income to start your money management journey. You don't need to be perfect either. Make your own mistakes. Learn from the mistakes of others. Refine, rework. It will be a continuous process. Start. Because starting imperfectly is way, way better than not starting at all. And as we end this chapter, I want you to do this. Pause and reflect. Note down, number one, what are the mistakes you have been making with money? Number two, what could you have done differently? How? Number three, how can you do it differently going forward? Chapter 9. As long as I know this, don't believe everything that you feel. Not every feeling is a fact. Don't believe everything that you think. Not every thought is the truth. I believe that building wealth was about numbers, the amount we earn, then save, then invest, then get as returns. I believed that I was a rational money manager who made data-driven objective decisions. Yet, when faced with real-world choices, buy a house or rent, take a loan now or wait, startup or a job, pick stocks or mutual funds, I realized numbers don't drive money decisions. Our biases do, our emotions do, and our emotions make us do some very stupid things. Today, I know that we are all prone to biases that we don't even know we have. Sellers capitalize on this, so no choice is ever presented in a neutral manner. No one is immune. As Morgan Housel wonderfully said, money has a little to do with how smart you are and a lot to do with how you behave. And behavior is hard to teach, even to really smart people. We're drowning in information and jargon, not to mention well-meaning relatives who keep telling us how much we should have been earning and how Sharma ji ka beta